a gavel just slammed down at the Supreme Court, and with it, the entire era of universal tariffs just came to a crashing halt. Now, this wasn't just some political shockwave, it was a financial earthquake, and it just unlocked a massive, massive amount of capital. Take a look at that number. That's $264 billion. That is the river of cash that is now searching for a way back onto corporate balance sheets. This is a colossal shift of liquidity, folks, and it is happening right now.
And that's really the key, isn't it? This isn't just another headline to scroll past. This event has left a trail of footprints all across the market, basically creating a map of where all that money is about to move. So today, we're going to follow those clues. Okay, let's dive right in. Picture this. The date is February 26th, 2026. The Supreme Court has just declared universal tariffs illegal. And the immediate result? Well, you've got chaos in the headlines, but you've got incredible opportunity on the charts for those who know where to look. You see, while most of the world is busy debating the political fallout, we're going to act like financial detectives. We're going to ignore the noise of the headlines, and instead, we're going to analyze the underlying signals, the footprints, that the big players always leave behind. Our investigation starts with the US dollar. You see, for years, tariffs acted kind of like a tax on imports, which artificially propped up the dollar's value. Traders even called it the tariff premium. Well, the court's ruling instantly wiped that premium away, and that gives us our first major clue. Now, to understand this clue, we need our first detective tool, the Relative Strength Index, or RSI. The easiest way to think of it is like a market thermometer. It just tells us if an asset is running hot or maybe getting a little too cold. So here's how this thermometer works. When the RSI gets above 70, the market's considered overbought. It's basically running a fever. Below 30, it's oversold. Now, the really juicy part here is the signal. The dollar's RSI just broke down hard from a feverish 75. For traders, that's a crystal clear signal that the trend is reversing. The dollar is finally cooling off. All right, let's move on to our next clue. As the dollar weakens, investors often flock to tangible assets, stuff like oil and copper, and that drives their prices up. But here's the twist. That money is now running smack into a significant obstacle, a massive wall of sell orders. Our second tool for this case is the volume profile. Now, think of this as forensic analysis for the market. It doesn't look at time, it looks at price. Those horizontal bars you see show us exactly where the most buying and selling has happened, revealing where the big players have laid their bets. And this just beautifully illustrates where the action is. That longest bar on the chart is called the point of control, or POC. It represents the price level with the most traded volume, and it acts like a giant wall of buyer-sell orders. And right now, for assets like copper and oil, they are hitting this wall. Until the price can punch through that level, it's a major, major zone of resistance. For our third and final clue, let's turn to the digital world. With all this uncertainty, many people are looking at assets like Bitcoin as a potential hedge. And what's interesting is the charts are starting to show signs of a major rebound. Our last tool is the MACD. This indicator helps us track market momentum. It's designed to reveal when a trend might be gaining strength or, more importantly for us, when it might be about to turn around completely. So here's how it works. You have two lines that are tracking momentum. The signal we're on the lookout for is when the faster blue line crosses above the slower orange line. This is often called a golden cross. It's basically the market's way of saying the sellers are exhausted and the buyers might be ready to take control. Right now, Bitcoin is just inches away from this bullish confirmation, which puts a potential target of $70,000 right back on the table. Okay, so we've got our three clues: a weakening dollar, commodities hitting a wall of orders, and a potential bullish turn in digital assets. Let's put it all together up on the detective's board. This framework really connects all the dots. The political angle, that SCOTUS ruling, it points to a cash injection for tech and retail. In terms of performance, rising tensions in the Strait of Hormuz, which is a key oil choke point, tell us we have to watch that volume profile for resistance in energy prices. And finally, with the end of universal tariffs, we're going to see a shift to more targeted precision protectionism, and we can use the MACD to spot which specific sectors will benefit. So after this entire investigation, what's the one rule you should take away from all of this? What's the core lesson in separating the real signal from all the noise? Well, it comes down to this simple distinction. The headline is the SCOTUS ruling. It creates noise, and it can bait you into making emotional decisions. The footprints, though, those are the real clues. the RSI showing a reversal in the dollar, the volume profile identifying those key walls of resistance, and the MACDs signaling a potential shift in momentum. And this is the key insight. The news tells you what happened, but the charts, the data, the footprints, they tell you how the smartest people in the market are reacting to what happened. And that is a much more powerful piece of information. So, I'll just leave you with this question. We know the headlines are designed to create noise, to grab your attention. The real question is, armed with this framework, where will you start looking for the footprints?